Well, certainly a dismal report. As you say, only 0.3%. That 0.8 over the year is the slowest since 1991, which was a very deep recession. And obviously, when you consider population growth running at about 2.3%, then it's a deeply contracting in per capita terms. So very poor report, and it also mentioned the mix there. We had zero contribution from household and business investment, so the private sector very quiet at this point. The public spending, the public investment, look, I think people are pretty supportive of that. That bounced sharply. Infrastructure, renewable energy, hospitals, etc. That's apparently the driver, according to the ABS. So that's all right. But the economy growing very slowly. For the RBA, it's been very tolerant of slow growth. It hasn't sounded very worried about it. It keeps pointing to the job market, the job creation continuing month by month, pretty much really more robust than they had expected. So no radical change in their commentary next week, I would say, but they do have to take it on board that perhaps the economy is undershooting their expectations. So we have seen that market reaction in both FX and rates.
Yeah, there's some market chatter sort of suggesting that what we've seen as far as the data is concerned may actually prompt the folks over at the RBA to tone down maybe some of their hawkish rhetoric. But I suppose we'll have to wait and see, Sean. Given a lot of the global cross currents here and what we've seen in the Aussie dollar this morning at 64.30, 0.9% or so in the session, what do you think is the dominating factor? Because, you know, we've had the China data, we've got the threat of US trade tariffs. Now we've had the chip export controls, China hitting back against that with the rare earths as well, coupled with, of course, the macro picture over in Australia and what the RBA has been up to. What do you think is likely to drive this moving forward, the sort of dominating factor here?
Well, I think that the US and China are probably the key drivers of why we're this low. Given that, obviously the RBA hasn't been cutting rates and pretty much everyone else has. So for the Aussie to be as weak as it is, it does indicate that, firstly, you've got that real headwind from the US, strong US dollar. Partly that is anticipation of turmoil in global markets coming up, with the Trump administration likely to be aggressive on the tariff side. That can certainly spill over to such an open economy as Australia, especially as so much is aimed at China. That can certainly hurt Australia, and the potential for the US dollar to be more resilient. Not just in terms of protectionism, but that next year the Fed might not cut as much as previously thought if the new administration is going to pursue very loose fiscal policy. So that's a strong dollar headwind. And on the China side, for Australia, we've already got a waning trade surpluses. It seems to have peaked. That now we're back into your current account deficit the past year or so. And the Aussie is just consistently used as a proxy for Chinese growth. So until investors become more upbeat on the Chinese economy, however long that might take, perhaps there's going to be fresh stimulus in the new year or whenever, then the Aussie does tend to get punished in that role as a proxy for China.